Hello and welcome to this video. I thought, I've not been doing these monthly videos for a while, so I thought, let's get started once again. It's primarily been I've been caught up with too many things, doing too many different things, learning and working on different aspects, and some of it, which over the next few months, probably will see the day of light, and maybe I'll discuss about it, in future videos or in some of my future writings. But last few months have been quite exciting in terms of the kind of work that we've been doing and the kind of stocks and the kind of research that we're trying to do. A lot of it probably not been done before, at least in some scale in India. So, let's see how things progress, and as in when things pan out well, I'll come back and share things with you. So, like we used to do, I keep at least a few questions that I've got over email or through social media, and I'll discuss some of them. So the first question is the obvious one. The markets are at an all-time high and it continues going up. So should we book profits or should we stay fully invested? I think this is the most common question that I've received, and this is also a very common question whenever I speak to my friends, I speak to relatives, family members who are invested in the markets. Now, uh, this the this is the monthly log chart of the Nifty, right from when it started, 1991 till now. And I've tried to mark all-time highs along the way, and you will see that it's a journey of all-time highs, right? Uh, Start with Nifty started at 100 points. Today we are around 25,000. Uh, so it's gone up roughly 250 times in this period. And if you know look forward, another 5 years, 10 years, uh, the Nifty is going to double and quadruple from here. So if somebody tells you that Nifty is going to be at at 1 lakh, don't get surprised. It's just a matter of time, and it will happen, right? We are in a growth economy. The economy is growing. Businesses are growing. So all-time highs will get taken out. You know, and there's nothing sacrosanct about a particular level, right? Markets over long periods of time tend to go up, and that is the nature of the beast. So just because we are at one such point in time, there's no reason why a year, 2 years, 5 years down the line we should not be higher up from where we are today. So that in effect is my short answer to this. And just to add to that, what we see is that if you uh, and there have been numerous studies on this in terms of looking at rolling returns, and you see that roughly if you invest for 1 year, right, there's one third possibility that you might lose money. If you extend that time horizon to 5 years, there's about roughly 8% probability of you losing money. If you extend that to 10 years, then roughly it goes down to 3%, and then on a 15-year horizon, approximately 0% probability of losing money. So if you have a long-term horizon, uh, you are much better off investing in businesses, investing in equities, and if you look at the relative returns across asset classes and also the flexibility. Uh, every asset class has its unique features. For example, real estate. Uh, it's very illiquid. You cannot book partial profits, right? If you have a house, You cannot say I will sell the balcony only, or I'll sell only one bedroom and take partial money out if I need only a part of the money. You have to sell in its entirety. uh, Liquidity, you may not be able to get the money as soon as you want to. Gold, on the other hand, is very liquid, but it does not give you any cash flow during the period that you hold on to it. So, considering all things, fixed deposits, fixed income, most of the time you will not beat, real inflation if you're investing in fixed deposits, although it is liquid, although it is safe. Now, all said and done, you have to take my words with a pinch of salt, because I understand equities the best, and I invest myself in equities. Most or nearly all of my personal investments and net worth is in equities. So uh, I am definitely biased towards it. But I think equities, ultimately you are investing in businesses, and it is businesses which create wealth, right? If you look at the Forbes 100 of any country in the world or globally, it is made up of people who are owners of businesses, right? You will not find, uh, very, very rarely will you find an individual who's uh, who's not a business person who's there in that list. Once in a while, you'll find a celebrity, a film actor or a sports person, but most of the time, the reason why they are there is not because of their profession, uh, but because they have other, associated businesses with them, or they have ownership of businesses. They've been given stock. So, for example, like Mike Jordan, he has stocks of some of the companies that he endorses and things like that. So, uh, to cut it short, I think it's very important for us, as investors or as even common people in India today, to realize that we are in a growing economy, and participating in that growing economy is very, very critical. Now, I'm not saying that it will be bump free. There will be years when markets will go down. There will be years when markets will be flat, and there will be years when markets will go up. And that's par for the course. That's the way this is, and uh, that is the fees that we have to pay, or that is what we have to put up with if we want uh, better than inflation returns, or returns which will give us a decent amount of wealth creation possibilities. The next question is also very interesting, which was about rebalancing a portfolio, especially when some of the components or some of the stocks within that, if it has run up. So what do we do? So the way I think about portfolio allocation is this, that big money or uh, wealth creation opportunities are not very frequent. You will not find stocks that will go up 4x, 5x, 10x every year or every few months, right? So whenever you find a real winner, some and when I say a real winner, what I mean is a stock which continues to give good results fundamentally, and where there is price momentum, right? So both the fundamentals and the technicals of the setup are looking good. That is which no that is the kind of stock story that actually generates wealth. So it could be the HDFC Bank from 1995 to maybe around, say, 2018-19. It could be Bajaj Finance from 2010 to 2020, to, or and then there are numerous such examples we can give, with stocks which have given many manifold returns over a period of 5 years, 10 years, 15 years, right? The proverbial multi-bagger. So the point I'm trying to make here is to create real wealth, you need multi-baggers. And you will not get multi-baggers if you are very jumpy and if you start taking profits very quickly. So you will have to let the winners, run, and you have to cut your losses. That's the first thing. The next thing is, like I said, if there is no change in either the fundamentals of the business or the price trend, then you should, sort of probably hold on and resist the urge to book profits. Let it run. Uh, However, risk management rules, you should have some kind of risk management rules which necessitate a which is basically at a individual stock level, and which is also at a sectoral level. And you can define it in many ways. So just as an example, you can say that, for example, if you take, say, 5% as an initial allocation in a stock, you could define it as, like, 3 times to 4 times of that I will limit my position. So which means that if an individual stock goes up to becoming 15% or 20% of my allocation, then I will stop that, or I will sort of then cut my position there. Other than that, it could be possible that at a sectoral level, you can say that I will take 30% or 40% maximum allocation. And if holdings in any one sector goes beyond that, then I will sort of then self-limit myself. So these could be possibilities. The other important thing is when these allocations go beyond a certain level, so beyond your, say, predefined level, then you can start thinking of trimming it down. So, you don't need to sell off completely, but you can say that, okay, if it is gone, say, beyond 20% in an individual stock, or say beyond 40% in as a sector, you sell partially to bring it down to that level where till which you are comfortable. So that is the way I personally think about rebalancing in this particular context of one stock or a few stocks having run up a lot in the past. Portfolio rebalancing also has a lot of other uh, use cases. There could be many uh, other situations. For example, if the stock is not doing well, what to do? If number of stocks are not doing well, or if the market is looking weak, what do we do? So there are different combinations. There are different cases that we can look at. But for example, I mean, this is a particular case that the question was for, and I think just ensuring that you let your winners run and cut your losses. I think that's a very, very sound concept to think about. Next, there are a few things I just wanted to leave you with this month. Last week we saw the GDP quarter 1 numbers come out, and I think the only two things that caught my attention. One was that private consumption uh, has shown a little bit of pickup, which is very encouraging. And I think this also we're seeing anecdotally from the business commentaries from management of FMCG companies. I think that is where we get the first indication of consumption pickup. We are seeing some amount of recovery coming through or starting in rural, and that's very encouraging. If rural demand starts picking up, especially now that we've seen good monsoon, I think a lot of challenges in terms of inflation and growth could be behind us. The other point that we've seen here is that services, manufacturing, and construction, all three components have been very, very steady. They're all like, I mean, 7% or above in terms of growth, which is a very good number. So that's the first thing I wanted to leave you with, is that the GDP numbers, although are slightly lower than what was there earlier, I think it's been quite encouraging. The momentum in terms of business growth, in terms of how the things are going, seems to be fine. The second point I wanted to sort of you know just point out is that there is a lot of euphoria. Uh, I think there's been a lot of media articles recently uh, about the SME IPOs and the kind of not only numbers but the kind of oversubscription. I think it's becoming now like a case where people know that they will not get allocation, so they're just blindly applying so that whatever percentage they get, it's like just playing for the pop, right? And then go in and repeat that for every IPO that's out there, irrespective of the quality, irrespective of what business the companies are in, and that is the sign of a bubble, right? So very clearly in SME IPOs we are in a bubble, and it will, like all bubbles, end. When it will end, I do not know, but all bubbles end badly. And the problem is that when bubbles end, they have a contagion effect. They sort of impact others. So I will not rule out a possibility that there is a problem in the SMU IPO space, and then that rolls over to the primary and the secondary market in the main bourses, and that's something that we need to be very careful about. And unless there is some kind of systemic intervention in cooling things down, and I think that might actually also happen because now SEBI and the exchanges are also talking about the fact that SME IPOs are uh, not there is some amount of exuberance there. So I think there will be measures that will be taken. So this is something that I am personally also very concerned about, and we should actually keep an eye out for what is going on in this space. Lastly, I think we've just sort of completed numbers, quarterly results, and I was looking through the numbers. There are about 1730 companies uh, that reported numbers where revenue and profits both were positive. That's a large number, and the median revenue growth was 22.46%, which is fantastic. And the median net profit growth has been 62.09%, which is again fantastic. A large number of this is coming from the small cap space, where some companies have registered phenomenal growth, and you have to take case by case as to why some of those companies have grown and is it sustainable and things like that. But raw numbers at an aggregate looks quite decent. And on the chart to the right, you have Nifty 500, and this is the chart for nearly the last 14 years. And if you look at the P ratio, the median P is has been 23.5, and we are right now somewhere around 26 odd levels. So we are not, you know, cheap. We are somewhere around the median, slightly above median. But it's no way we can say that the broader markets are in a bubble territory, right? So it's not even uh, at the level in when the mid caps started correcting in 2018. We are actually pretty far off from here. You can see from the chart in 2018 the median P went up to around 35 uh, for Nifty 500. So broadly, economy is doing well. We are seeing some sort of a bubble uh, being formed in the SME IPO space, and uh, businesses are also doing fine. That is the key takeaway that I have for you for this month. Thank you for listening. If you have any questions, feel free to share them with me, and hopefully I'll be able to get back to you soon. Thank you.